Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. Sam writes, "Hi Stuart and Campbell, love the podcast. Sometimes I drive the long way to work just to listen to the end of a good episode." I didn't know that the podcast was so good that it prompted spending more time commuting in the car. So anyway, thanks Sam, that's lovely feedback. I've got a question here that has been asked 1,000 times on every investing podcast, but hopefully this time with a slightly different angle. I understand the key attraction of property over shares is the leverage with the increased ability to borrow against this asset class. And also I understand from your previous podcast that to maximize this leverage benefit, it's best to borrow 100% of the purchase price. However, to buy an investment grade asset, if an investor does not have enough borrowing capacity to borrow 100% of the cost and to fund the purchase also contributes a cash deposit, at what point or what level of gearing is it likely to provide better long-term outcome to simply invest in shares? Or to put it another way, will an investment grade property still outperform shares assuming a long-term historical performance continues if the property is initially purchased with a, say, 80% gearing rate or 50% gearing rate? That's a really interesting question, Sam. I reckon the answer is, that you've hit the nail on the head. The attraction to property is that you can borrow the full cost. The cost of borrowing typically is lower than investing into shares, so margin loans and so forth. And then the third element is, there's the third and fourth. The third element is no margin calls, so you don't have that risk of having to potentially sell if the price drops. And then fourth, half the volatility, right? So, one of the concerns, if I go and borrow $1 million and put it in the market today, at market's all-time highs, we have a volatility event typically resulting in a 35% drop in share markets every 5 to 10 years. That typically happens. So, if I go and borrow $1 million and put it in the market, it's possible that I wake up tomorrow, the market crashes and I've got $1 million loan and my portfolio is only worth 700 or 650 even, and that doesn't make me feel good. Whereas with property, tends to move sideways or up. Sometimes it can come down, maybe 5 or 10%, but it's, the volatility is much lower. So you put all those things together and that's the attraction really. So then you got to think about, well, if we're looking at equal levels of gearing between property and shares, then I would say shares are better because more predictable levels of income, no associated costs, the chances of legislative risk is lower, so things like changes in land tax, all those sorts of things, and we've got a highly liquid market and I can buy incrementally and sell incrementally. So I know that, for instance, if I used an internally geared ETF, such as BetaShares Diversified Internally Geared ETF, the ticker code is GHHF. That's geared between 30 and 40%. I know BetaShares also has GEAR, GEAR, is the ticker code. That's just an Aussie ETF. That's geared between 50 and 65%. When we sometimes employ a gearing strategy with investing in shares for clients, and what we will do, we won't use a margin loan, but we'll use equity and property. And so, for instance, the client might have $5,000 a month to invest in the share market. We might also then go and borrow $5,000 a month by drawing out of an existing investment loan that we set up and then invest $10,000 in total. We typically won't go over 50%. I kind of like the fact that it's sort of 50%. It should be cash flow positive still in most interest rate settings, not all, but most. So it's not giving rise to sort of negative cash flow, but you're getting some gearing into the portfolio. So given, that's our approach in our business, and of course, other advisors might have a different approach, but given internally geared ETFs are somewhere between 30 and 60%, I reckon that's the cutoff. Because if you start to have lower gearing than that, then I would probably go into shares. Now, having said that, there's two things we want to think about. Firstly, that property, investment grade property, provides most of its return in compounding capital growth. So it depends on, it's about choosing the right club for the right shot. If the golfing analogy, so you're not going to tee off with a putter because that's inefficient, right? You want a driver to be most effectual, get you the most distance when you tee off. So if you're a young person or your goal is really building your asset base, then really what you want to do from a mathematical perspective is you want an investment that, say, is going to generate 8 to 10% compounding over a very long period of time. You want almost all that return. You want $1 of income, so your interest deduction, you get your interest deduction, and you want all the rest, almost 10% in capital growth, because that's the compounding nature of growth. growth. It'll benefit from compounding interest. Easiest way to build wealth over time. Just requires the right asset and a lot of patience, of course. So if I was young, say in my 20s and 30s, even if I'm geared at 50%, I still might lean towards property just because of the compounding capital growth. In share markets, you're going to get 50% income, 50% growth, probably, right? Even if the yield's a little bit lower in international, there's going to be a little bit of turnover there. That's probably the conservative assumption from my perspective. The other element of property versus shares is that with property, you're forced to invest a lot. Now, of course, that can be seen as both a pro and a con, right? The con is, well, it's a big amount to stomach to begin with. But the positive is that it forces you to invest more sooner. In a way, that's kind of good. If I'm in my 30s, I want to buy an investment grade property, I have to spend $1.2 million, which is a lot of money, particularly for a 30-year-old. That's, it's going to give me indigestion, but in the long run, the compounding capital growth off a really good quality asset is going to do its thing. Whereas with shares, I've got the flexibility. I can just drip feed in the market. I can invest regularly, but also I can stop. If I feel, my cash flow is a bit tight this month, I'll turn it off, and maybe then I don't turn it back on for another 6 months. That flexibility to not have to invest a lot or to invest regularly, again, is a double-edged sword. So I think it's around 50% would be the kind of cutoff. 80%, I think property is still going to beat shares in terms of a gearing rate, but they're just some of the other sorts of considerations. But thanks, Sam. Thanks for your question. It's a good one. Okay, next question is from Bob. Thanks for your podcasts are a wealth of information. Thanks for your great service to your listeners. Thanks for giving your time. You're very welcome, Bob. Bob tried to post this on YouTube, but didn't come up in the comments. Just to let people know, I don't want to create a lot of extra work for myself, but I do reply to all the comments on YouTube. So if they appear, I'll reply to them. Anyway, Bob emailed this question, so I thought we'd answer it in this format. Okay, my situation is that I'm in my early 60s and have a primary place of residence in Queensland and 2 investment properties in New South Wales. None of the properties have a mortgage and all properties are in my name. My wife and I are planning to move abroad and retire and would like to reduce to 1 or no properties. I've held the investment properties for a long time and they have capital gains of 400 and 700 after the 50% discount. So really that's taxable gain, total taxable gain of $1.1 million. And then if it's taxed at, 47% on $1.1 million, you're going to pay probably $500-ish thousand in tax. Okay, I could pay, think about taking an investment loan against the investment property with a larger gain, and at the end of the tax year, prepay the following year's interest. So I'll just interject here before I read the rest of the question. You can't do that, Bob. In fact, and for all the Bobs out there, whether the interest in respect to a loan is tax deductible depends on the purpose for which that loan is used. Now, if I have 3 unencumbered properties, so 3 properties with no debt, and then go and get a mortgage, the interest on that mortgage isn't necessarily tax deductible, even though it's secured by an investment property. The big question would be, what did I do with the loan funds? You're going to have to do something with the money. So, if you put that money into a term deposit, for instance, then it will generate interest. Of course, you'll get a tax deduction, but you're at a loss. You wouldn't do that because the interest rate on your term deposit is going to be lower than the mortgage interest rate. So you'll make an income loss. Okay, you'll get a negative gearing benefit, but you're still losing money. So you just wouldn't do it. So in essence, the only way you can really re-gear property, or in Bob's situation, create a tax deduction, would be to change the ownership. But you don't want to do that because that gives rise to stamp duty and capital gains tax. So essentially, once you have repaid a loan, it's gone forever. There's nothing you can do to get it back. And that's why I talk about in the podcast often is offsetting loans rather than repaying them, so that you've always got access. You can always pull the cash out of the offset and do something else with it if you want to, and notionally end up, and practically that ends up kind of re-gearing the property. Okay, Bob, so you can't create an interest deduction to reduce your capital gains tax. Okay, I'll go on and read the rest of the question. I could also pay $170,000 into super using the 5-year catch-up rules. Those interest and super payments, we'll forget about interest, those super payments will effectively reduce the tax from the sale of the investment property to a lower gain. I can then also sell the principal place of residence in Queensland and move into the remaining investment property and turn it into my primary place of residence, and shortly thereafter leave Australia and rent it out. The investment loan and proceeds from the sale of the investment property and the original principal place of residence would be invested in ETFs. As we are permanent residents, we would have to pay land tax surcharge, which is 5% of the land tax value, and would more or less wipe out the income. However, I could return to Australia and take up residency again and either sell the principal place of residence or reset the 6-year clock. Meanwhile, a capital gains tax period that the primary place of residence will either be subject to it gets a bit convoluted. Maybe I won't read the rest of the question necessarily for listeners. Let's just answer Bob's question. Bob's got 3 investment properties. He's going to move overseas to retire. There's 2 things we need to know. When that happens, we become a non-tax resident from Australian tax purposes when we sever ties with Australia, which means we permanently move. So, if that's the plan, then it's likely Bob will become a non-tax resident. If you're a non-tax resident, you don't get the 50% capital gains tax exemption, discount I should say, and you don't get the main residence exemption, which means the 6-year rule is no longer available to a non-tax resident. Changed in 2017. So really, in Bob's situation, you're not going to contrive, go and borrow and invest in ETFs or something and create this deduction. I mean, if you do that, you're going to get capital gains and income from the ETFs, hopefully. So, I'm not sure it really changes your tax position very much. The only thing you can really do to offset a capital gain in most circumstances is use the carry forward concessional contribution. So as Bob said, if your balance is less than 500,000 at the beginning of the financial year, and you can go back 5 years. And if you haven't used the concessional cap, which at the moment's 30, but a couple of years ago it was 27,500, sorry. So if you haven't used that full cap, you can always use it. And that's a good way. Sometimes what we will do is not make a contribution this year if we know we're going to sell a property next year, because we'll rather utilize 2 years of contributions next year than, one each in each financial year. But Bob really should sell all the properties. Yeah, sure, you're going to pay a bit of tax. You make the super contributions, but you're going to pay a reasonable amount of tax. But there's no point hanging on to the property because the gains will be taxed. Really, 100% of the gains will be taxed, which essentially means that 50% of that gain is a tax liability. It doesn't make sense. Whereas Bob could sell the properties and put the money in ETFs, in Australian ETFs, then go overseas and become a non-tax resident, it's very likely he won't pay any capital gains on that ETF portfolio nor income tax. And that, from a taxation perspective, assuming returns are equal between the shares and the property, you're miles ahead because one is tax-free and one is taxed at a significant amount. Having said all that, Bob, you should go and get specific tax advice. This is not advice, it's only information. The residency rules are really complex, and there might be things in your situation that mean that there could be other opportunities or things I haven't thought about or I'm not aware of. So just with these sorts of decision making, it's really important that, you don't rely on writing a question into a podcast. I appreciate the question, Bob, of course, but it's really important that you make sure you get some really good advice so people understand the exact scenario, because there's always exceptions. There's always, other things that we need to think about. Anyway, thanks for your question, Bob. Okay, next question from Vanessa. I've been following your podcast religiously every week and truly enjoy the insights you share. I found the information incredibly valuable and thank you for sharing the wealth of knowledge to many listeners. You're most welcome. I'm reaching out in the hope that you can offer some guidance on the decision I'm currently weighing whether to keep or sell an investment property. My husband and I purchased a 1-bedroom unit in Hillside, New South Wales, just south of Sydney CBD, of course, near the coast. Hillside in 2014 for $346,000. It's all we could afford at the time. I estimate the value is around $580,000 today, which hasn't quite doubled as we'd hoped, likely due to it being a one-bedder and not investment grade property. The capital gain sits at $240,000. Of course, it might be slightly less than that because you've got stamp duty and selling costs. But anyway, the property is currently rented at $600 per week and we are paying interest-only repayments of about $1,500 per month. Loan balance is just under $300,000. I believe it's positively geared. Given the modest growth, I'm wondering whether we would be more beneficial to sell the property, pay the capital gains tax and contribute the proceeds into our superannuation. For context, my husband's 62, semi-retired, earning $30,000. I'm 55, working full-time on an annual income of $123,000. Combined super balance is $560,000. Home is fully paid off. We have another investment property, which is a 4-bedroom home in Brisbane on a large block with plans to add a granny flat. Value is $790,000 with a $370,000 loan, $620,000 per week in terms of income. Expecting to receive some money and plan to contribute around $300,000 of that into super. Understand the information you provide is general in nature and not personal financial advice, but I really appreciate your thoughts on the pros and cons of selling this property versus holding it? Thank you. Vanessa, it's a great question. It's a good question everyone should be asking. Particularly, I have recorded some podcasts this year about, benefits of super, tax benefits of super, and the fact that we can have, 2 million of super each and not pay any tax. So, $4 million of total value. And so in your situation where you've got, super investment properties and so forth, what's the point of paying tax, capital gains tax, income tax, all those sorts of things when you could just move those assets inside super? I guess when we look at the performance of the property, if you look at the growth, I calculate 4.8% in terms of compounding capital growth over the period of time you hold the property. It's, average. It's okay. It's not great, of course, like you've said. I think one bed apartments, firstly, can't beat yourself up. Like if the entry level was at what you could afford at the time, then you've done the best that you could do given the circumstances. But if people's circumstances change, then, it's like that saying, if you find yourself digging a hole, stop digging. It's a sunk cost. The previous decision is a sunk cost. What we need to do is make the best decision today and not be hamstrung necessarily by the previous decision. So what I'm sort of saying is when I look at these sorts of questions, I ask myself, it's not just because we are here doesn't mean we need to stay here. So just because we own this property doesn't mean we need to continue to own this property. We need to make the best decision. So when we look back in 10 or 20 years' time, we're happy with that decision. Okay. So one bedders, I agree. I don't think I'd ever buy a one bedder personally anymore or ask a client to do so just because of the work from home, that sort of stuff. So it's probably done what it should do given the asset type and quality. So I don't think we should be unhappy with the return. I think it would be putting it differently, it would be unreasonable to expect the property to have done better than what it has, I think, just given the nature of the property. So, I think we've got to be realistic when we look at performance, and that would be my realistic viewpoint. Now, if you add in 30% for costs, holding cost, maintenance, management fees, all those insurance, all those sorts of things, the net rental yield is still pretty high, 3.8%. So 4.8 growth and 3.8 income gives us 8.6% total return over the ownership period on average, right? I haven't looked at the actual numbers, but of course, because I don't have the tax returns and whatever, but so it's not a bad investment. Like it's not terrible. Like if I was going to put money into super, I would say, look, your long-term returns are going to be 7-10%. And now they've been double digit more recently, but we can't think that's going to continue, of course. We've got to expect some volatility, but 7-10% is what I would be thinking. Well, that's kind of smack bang in the middle of that range. So it's not a bad asset, necessarily a bad asset. And if it's positive cash flow, it's not costing you any money. And, if you're getting closer to retirement the further away from it, of course you are, then, the borrowing capacity element, because I did, return on borrowing capacity a few weeks ago, I talked about that, making sure that that's working hard for you. Well, that's less important in your situation because you're not going to go out and borrow more money probably. So would I sell the property now? I probably wouldn't. I'd probably be focused on reducing capital gains tax. And, if you both have taxable incomes, then it doesn't make sense to me unless you can use non-concessional, carry forward non-concessional, as I spoke about in the previous answer to a question, to dramatically reduce the amount of capital gains tax you're going to pay, then I probably wouldn't sell it now. You're probably going to pay about 50,000 in we won't pay probably more than 50,000 in capital gains tax. Of course, that's just sort of rough numbers. So we're not talking about cheap stations here. Like it's not life-changing amount, but it's reasonable. I think what I would do if I was in your situation is you definitely want to get the money into super, I think. And I find that people that get into retirement, not initially, but 5 years after retirement, most clients are looking to simplify their circumstances. So when we're working and we're managing investment properties, it's not that big a deal. But I think as we get into retirement, we just want to make things simple as possible. And I find more clients say to me, 5-10 years after retirement, let's sell the properties. I don't want to deal with the tenants anymore. I don't want to deal with the maintenance, all that sort of stuff. So I think it probably aligns with generally where you'll probably head. And so what I would do is I'd hang on to it because I don't think it's not a terrible asset. You're getting a pretty good return, giving you some diversification. But when you both retire completely, I would probably sell it in a tax year where you're not going to have much in the way of taxation. And assuming that you own the property jointly, you'll probably end up paying less than $15,000 in tax. So there is a reasonable saving there by waiting until retirement, and at least you'll pick up the returns. And as I said, I don't think it's such a bad asset. Then you've got to think about what you want to to do with the Brisbane property. Granny flats are okay. It's going to increase the rental income, but also you've got to think about, whether it changes the nature or style of the asset. I remember coming across something, I think with a client, and they might have had a property with a granny flat and then they tried to sell it. Not everyone wanted that. It was a little bit weird in terms of sort of construction. So it depends on what's in the area, but it's just something you want to sort of think further about perhaps. But yeah, so Vanessa, hang on to it, maybe sell it when you're fully retired. But as you correctly identified, not advice, just giving you my thoughts at this stage. Okay, next question is from Julie. I wanted to say how much I enjoy your podcast since I discovered them 12 months ago. I think you have some of the best financial and investing content available, and I listen to lots of podcasts. Thanks so much, Julia. That's really lovely to hear. I especially enjoy listening to the case studies that you present. I've shared them with many friends, and thank you for everyone that shares the podcast. Of course, the more the merrier, and congratulations on doing a wonderful job. So thanks so much, Julia, for your generous feedback. I hope you can provide some insights into my current financial position. For context, I'm 53 years old, no dependents. Current financial position, super is held in a Macquarie wrap with managed through a financial advisor. Currently, approximately 2.36 million invested in US and ASX ETFs, with a small exposure to ex-US and some REITs, and a 30% holding in direct Aussie shares, which was in existence before the super was transferred onto the wrap in 2021. Performance has been 11.5% per annum since inception for this portfolio. I don't know the period of time, but that doesn't sound too bad. Julie's also got a whole bunch of cash outside of super, about 1.3 million, I think, and then another share portfolio of about 850. That's also returned, 17.5% since inception. So again, no investment properties, no mortgage, homes valued 1.6, and living expenses about $10,000 a month. Okay, so Julie lives off the cash holdings and reinvests what's left over after paying for living expenses in respect to the earnings. So the earnings are just reinvested in the portfolios. She's got some health concerns and she's still indecisive about her ability to work long term and therefore is reluctant to invest those funds. And essentially, she's asked for my feedback on her situation. So, obviously the returns you've quoted, again, I don't know the time period, so I can't really benchmark them, but they seem positive. It seems like whatever the advisor's doing with both those portfolios, both inside and outside super, seems to be going well. You say you want sort of 200,000 of annual income. Well, your financial advisor can put some projections together, but I imagine $3 million portfolio plus the cash outside of 1.3, you don't need a huge return in order to achieve that. So you probably, put a different way, I would ask your financial advisor, the question I'd ask is, if I don't invest that 1.3 and I just earn an interest rate, let's say of 3% or something, 3.5%, let's be conservative, will I still have enough money to pay me so that I can spend $200,000 a year after tax? That'd be the question I would ask. Or what return do I need from that portfolio, the super fund and the share portfolio in personal names, in order to do that? Because that'll inform you about whether you actually need to invest that cash. Because that's more than a question of not necessity, but preference. And that's what you want to ascertain. So if the financial advisor said, okay, you've got nearly 3.2 million in portfolio to generate, so you've got enough money to live for $200,000 a year, you only need to generate a 7% return, then I would say to you that whether you invest the cash or not is completely a discretionary decision rather than a financial necessity. And I think it's important for people, for people like Julia in this situation to ascertain what is important. Because sometimes it's good to be conservative, but if you're going to be so conservative that it's going to put your future at risk, then you want to know that. And, it might be an education piece. Hey, we've got to invest more. We've got to invest this cash because otherwise we're not going to earn the return that we need. So that's the first question that I'd ask the financial advisor. And since you've got a financial advisor, you can obviously ask them that question. But I think the answer, my gut feeling is, I think the answer is you don't need to invest the cash if you don't want to. That you've got enough money to achieve what you want to achieve. most likely. I haven't done the numbers, but that's my gut feeling. And I think, leaving that money in cash isn't such a big deal, particularly while stock markets are high. Now, I might do an episode on this, I'm not sure, but I've been thinking, there's a lot of evidence that might suggest that the bull market will continue, like that stock markets will continue for maybe a few more years. So I'm not one of these doomsdayers, at least not at this stage, thinking, well, the market could crash tomorrow. Although if I woke up tomorrow morning and the market had crashed, I would not be surprised either, right? So I'm not ruling out, but I don't think necessarily it's going to happen. So if I was in your situation, Julia, I think I would just keep the money in cash, particularly if it made you comfortable around, indecision around working and health and these sorts of things. But I would earmark that cash to be invested when the market presents an opportunity to you. So for example, if it did drop 20%, I'd start gradually, progressively investing the money and buy on if the market keeps falling, buy on the way down and then buy on the way up. And then I'd deploy that money in a really strategic, disciplined way. But I wouldn't be that worried. I wrote, you mentioned the episode 368, Keep Your Powder Dry, which was, the episode was really around, don't be so worried about necessarily investing a lot. I've got a lot of cash in my self-managed super fund, for example. At the moment, I'm quite happy just to leave it there. I know, over the last sort of 15 years, I've been a bit more strategic about investing and just waiting for the right time. I'm not paranoid about maximizing the return on my money every single month, for instance. So if I've got more cash than I really need in super, so it's not invested, it's earning a small interest, I don't know what it is, but it's earning something. It's not nothing, but it's not invested, and it's there for next couple of years. It's not that big a deal, because then if I deploy it when the market drops, well, the upside is much, much greater. And I've got the optionality value of doing so. So that's what that episode was about. And I think in Julia's situation, providing that I didn't need to invest the money in terms of earn a return in order to hit her goals, I would be most happy just to leave it in cash for now, especially given the uncertainty, given that oil markets are all-time highs. But then I'd invest when there's a large drop. The thing I always say to clients, though, is yes, whilst our strategy might be to invest when there's a large drop, when I come to you and say, let's do this, it will feel very risky to do. At a time when there's peak uncertainty, that's the best time to enter the share market in a big way. But by definition, there's peak uncertainty, right? So it feels scary because there's so many unknowns. It's like the world's going to end tomorrow kind of mentality, but you've just got to separate that emotion from the financial decision. So I always sort of pre-warn people that this is what we're going to do. In the cold light of day, people go, yeah, no problem. And often, in these surveys, people go, well, if the share market dropped 30%, how would you feel about investing more? And they just go, yeah, no problem. But what you've got to do is put yourself in those circumstances. And the circumstances are that there's huge level of uncertainty. Maybe it's a potential World War III, maybe it's a pandemic, maybe it's a GFC, whatever it is, that the banking system is going to completely collapse. That's the sort of mentality we've got to put ourselves in at that time, given those situations and how you would be feeling. Would you then invest a whole bunch of money in the stock market? That's how you need to kind of frame the question. Anyway, I wanted to talk about that because, of course, the market's been doing really well for the last few years. When a correction happens, I will do an episode. I'll record an episode and talk everyone through it and share my views about it. But, it's human psychology to obviously be concerned about these things, but you got to be a little bit sort of counterintuitive, if you like. Anyway, Julia, thanks for the question. Thanks for everyone that writes in the questions. Keep them coming. I enjoy answering them. And tomorrow, I'm going to talk about momentum investing as a strategy. And I'm going to talk about it from a share market perspective. And then I'm going to apply some of those learnings to property as well. Okay, until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.